Hi, everyone. I'm Mani, the CEO and founder of Valur. In this video, we're going to be talking about charitable remainder annuity trusts, also known as CRATs. What are they? Their key benefits, how do they work, and critically, when should people use them? So let's get started. A charitable remainder annuity trust is a type of charitable remainder trust, also known as a CRT. There are two key types of charitable remainder trusts: charitable remainder annuity trusts, CRATs, that we'll be talking about in this video, and charitable remainder unitrusts, also known as CRUTs, that we've talked about in previous videos. Both of these types of charitable remainder trusts allow you to defer the associated taxes when selling an asset, reinvest the sales proceeds, all without paying taxes. In addition, you receive an immediate charitable deduction now when gifting assets to these trusts in exchange for donating a small portion of the money in the trust to a charity at the end of the trust's term. The main difference between a CRUT and a CRAT is that a CRAT, or charitable remainder annuity trust, pays a fixed annual amount to the designated beneficiaries for the length of the trust. The value of that annuity is calculated as a fixed percentage that doesn't change for the length of the trust, a fixed percentage of the initial value of the trust assets. But that amount, that fixed percentage, has to be at least 5%. So for example, if you put $1 million into your CRAT, chose a 5% payout rate, you'd receive $50,000 per year for the length of the trust, no matter how the investments in the trust perform, whether they grow 100x or do not grow at all. A CRAT may last for a term of years or for the donor's life. And when that term of the trust is over, any funds left in the trust are then donated to the charity that the donor chooses. And this is why you receive an upfront charitable deduction. Most critically, CRATs are tax exempt, meaning that you'll pay no taxes on almost all gains realized inside the trust. This is why people often use CRATs to sell highly appreciated assets. It allows them to defer the taxes they would otherwise pay when selling an asset and reinvest those dollars to create more wealth for themselves. Most people are curious about, what does this mean from a numbers perspective? So let's walk through an example of a situation of how it impacts someone if they used a CRUT and a CRAT. Erica's a 36-year-old Californian with $1 million of time equity that she acquired at almost no cost. She set up a CRAT for 20 years. She'd receive a $100,000 charitable deduction up front, about 10% of the value of the assets she put in. With her CRAT set up for 20 years, Erica would receive about 5.39% of her initial trust value every year. So every year she'd receive about $53,900. And over the course of 20 years, that'd be about $650,000. Now, on the other hand, if she set up a CRUT for 20 years, and I would recommend you watch our videos on CRUTs if you haven't, she would receive the same $100,000 charitable deduction up front. Now, for her annual payout rate, Erica is entitled to 11% roughly of trust assets every single year. So that means in the first year, she'd receive about $110,000. Now, that number changes every year based on the value of the trust assets. It's not a fixed amount like a CRAT. So over the course of her 20-year CRUT, assuming normal growth rates of the investments, Erica would probably receive about $1.4 million. As you can see, it's a significant difference of what she would get from the same assets if she used a CRAT versus a CRUT. In conclusion, CRATs are great tools if you're looking to sell and diversify an appreciated asset and take advantage of the tax defer nature of charitable remainder trusts. And at the same time, you really care about consistent, locked-in payments, and you're willing to give up upside in your future growth. With charitable remainder annuity trusts, because you're signing up for fixed annual payments, these CRATs do bring welcome certainty in terms of the payments you're going to get, but the returns are likely to be lower than a CRUT, assuming normal market returns. Because while the assets in the trust are likely to grow over time, your payments won't change. And those gains will be stuck in the trust and will pass on to the charitable beneficiary, which may be a good or bad thing depending on your goals. If you still have any questions about CRATs or charitable remainder trust, please let us know in the comments below. Or you can also visit our website at Valur, VALUR.io, to play with our calculator to see your potential returns, sign up for a call, or read more materials. And a quick word about Valur. We have built a platform to give everyone access to the same wealth building tools billionaires like Mark Zuckerberg use. We make it simple and seamless to understand your options, evaluate the ROI of these options, and set up these structures and administer them at a fraction of the cost of competitors.